Bismillah, alhamdulillah, wassalatu wassalamu ala rasulillah. Assalamu alaikum wa rahmatullahi wa barakatuh. Welcome to our webinar from DEEN Support Services about the RSDP, the Registered Disabilities Savings Program. Is it called
Savings Plan?
Savings Plan,
Yeah.
sorry. And with us today is Imran Choudhary.
Yes.
Imran has 11 years of professional work experience as a management consultant and 14 years of financial services industry experience with IG Wealth Management, a Bank of Montreal, RBC, and CIBC. He holds an MBA from Schulich School of Business and is a certified financial planner, chartered life underwriter, and certified health insurance specialist. He was an executive board member for the South Asian Legal Clinic of Ontario and chair of the Citizen Transit Advisory Committee for the town of Oakville. Thank you for joining us today, and thank you, Imran, for agreeing to do this webinar with us. It's something that a lot of people with disabilities want more information about. So alhamdulillah, I'm glad that you're here. I just want to mention that the process that we will follow is that Imran will give a brief presentation, and after the presentation, we'll open it up for questions and answer. So I'll hand it over to you. Please go ahead.
Okay, brief. Wow, you haven't really met me, but okay, we'll see what we can do. And thank you for the introduction. I sound extremely boring, but anyway, let's see how that goes. Another little bit thing about me, I have a twin brother. So if you see somebody that looks a little like me walking around and you stop me to ask me financial questions, it might not be me. So, just take that with a grain of salt. And what else? My dad, who passed away, unfortunately, 15, 16 years ago, was the architect of the Isna Mosque. So he built that mosque. So so he designed, well, built it physically, but he designed the mosque. And I'm married, and I have two children, 13 and 17. That's more interesting than the other stuff, but let's go from there. So I am a certified financial planner. Let's talk about what this is. This is going to be more of an educational type of seminar. It is not a marketing seminar. So what does that mean? I don't know who's on the line here, other than I see in the chat box. I don't know anything about you guys. And nor do I want to, in the sense that I'm not going to be following up with anybody here, right? This is not about me trying to get clients or anything like that. This is me giving you information. And they'll have my contact information, the hosts of this session. And if somebody wants to reach out by email to ask me questions, no problem. Absolutely happy to help. If somebody wants to call me, that's totally cool too. But I think email is probably the best thing, because we can go back and forth with questions, and then I'll be better able to give you some stuff, info. So I am going to share the screen now, and I hope you can see it. We're good?
Yeah, we're good.
Okay. Okay, cool. I kind of stole your logo, so I hope that's okay. But I hope it's the most current one. I just found it on your website. So there's about 15, 20 slides. We're not going to go through all of them in detail. They are there. What I'm also going to say is, you don't need to worry about making notes, right? It's not because the deck is here. In fact, I would say the best piece of information, there's a very brief brochure. I may have sent it to Sister Zainab. If not, I will send it to DEEN Support Services, and it has a lot of this information at a very high level, 4 or 5 page sort of document that would be pretty useful as well. But again, you can watch the recording, because it does help having somebody speaking as we're going. So ground rules, anybody has questions, you can hold on to them until the end, or stop and ask if it's something very pertinent to what's on the slide, and not a problem. Let's see how this kind of goes. There'll be a bit of detailed info. I might kind of gloss over some of it just to respect the time that we have, but I'm going to get to the main points here and try to be brief, or more brief than I usually am. So, okay. Let's see how this works. Just trying to Okay, this is just some legal stuff that I have to put in slide decks that nobody cares about. So, okay, so here we go. So we're going to talk about, the importance of planning. I'm sure it's not going to be a surprise to many people here that an estimated 1 in 5 Canadians aged 15 and over has identified as having one or more disabilities that limit them in their daily activities. That's from a 2017 survey. I don't know if there's been an updated one. I don't believe there has been. But more than 2 in 5 Canadians with disabilities say they have a severe or very severe disability. So then if you support a disabled loved one, or also if you are disabled yourself, not all these questions are relevant, but collectively, questions that pop up are, where do I begin to save for the future? Will anything I do impact my loved one's social assistance benefits? Like if I was a parent or what have you. Are there any tax benefits or government programs available? And if something happens to me, how can I ensure my loved one is cared for? And as we all know, everybody's is different. It's impossible to cover every situation in one seminar, but these are very common questions. And together, if you speak with an advisor or your bank or what have you, these are the sort of things that you should be discussing with that person, individual, institution, or what have you. I'll go to the next slide. So a registered disability savings plan. I'm going to assume, just because there'll be people on the call, there'll be some that have heard about this and some that have never heard of one before. I'm going to assume that nobody knows what it is, and we'll just kind of go on a very baseline and work from there. So a registered disability savings plan, most people have heard of RRSPs and RESPs. Those are the ones that are most commonly referred to when they think about an RDSP. So I was, so an RDSP provides a combination of government assistance savings and tax deferred investment growth. So, let's just kind of compare how it differs from an RRSP and an RESP. So an RRSP, a registered retirement savings plan, is a plan that any adults can open, well, not even anybody can open as long as they have income. And what happens is you can make a contribution to an RRSP, and your contribution is tax deductible. So if somebody made, I'm just making up a number here, if somebody earned $30,000 a year and they contributed, let's say $3,000 to an RRSP, the government would then say, hey, we're going to deduct the 3,000 from the 30. So now it's like you only earned 27,000 this year. And why is that important? Because they will then say, you know what? You earned 27,000, but you paid tax on 30,000. So you paid extra tax on $3,000. And we're going to give you that tax back in a refund. So when people do their tax returns every year, and if they contribute to an RRSP, they often get a refund, and it's based on, and that's how that's calculated. Now, is government matching available in an RRSP? No. So whatever you put in is what's in there. Can anybody contribute to a plan for an RRSP? No, just you. There is a situation where you can set one up for a spouse, but his or her contribution would, if they put it into your plan, would be taken away from theirs, right? And because you get a refund on the contribution that you make, when you take the money out later on in retirement age, let's say 65 and over, you will pay tax on 100% of whatever comes out of there, but it will grow tax deferred in the meantime. So that's how an RRSP works. An RESP is a registered education savings plan. So for those of you that have kids or remember being a kid, that was a plan that your parents may have been able to do, or you may be able to do for children, and where you can make a contribution. You do not, unlike an RRSP, you do not get a deduction, tax deduction when you make the contribution. However, there is government matching available. So whatever the contribution you make to a maximum of $2,500 a year, the government will give you 20% on top of that. So most people open these up just so they can get 20% free from the government every year. And again, it's the same deal, only the parents or the subscribers are the ones that can contribute to the plan. And when the child takes the money out of the RESP, the withdrawals are taxed, part of them in the kid's name and part in the parent's name. The parts that are taxed will be in the kid's name, but you would suppose that the taxes would be very limited because the kid is still not really working. Now, an RDSP is kind of like a hybrid between an RRSP and an RESP. You can make a contribution. They do grow tax deferred, but you don't get a deduction. However, you get matching available, and the matching is significantly larger than anything you'd see in an RESP. We'll get into numbers later, but that's the reason you go for the RDSP. There's a lot of free money that you can get from the government. Anybody can contribute into the plan, so it doesn't have to be your parents or you, it can be anybody. And part of the withdrawals are taxed a little bit. So we're going to go to the next slide. So again, this is the same kind of thing. It's a RDSP. It's a registered matched savings plan for people with disabilities. We'll get into how you qualify for it later on. It's designed as a long-term savings plan to help the beneficiary be better financially prepared for their future. So it is a retirement plan. That is the purpose. Very similar to an RRSP in that way. And that doesn't mean that you can only have an RRSP or an RDSP. You can have both if you qualify. There are some things you have to be aware of. So for every dollar that goes into an RDSP, the government can match up to $3 depending on family income in grants. So that's a lot. Like, that is so amazing that you can make that much money on these things from the government. And if people are living on very low income, you don't even have to contribute. The government will put in $1,000 each year for up to 20 years in bonds. So if you don't have any money to put into one of these plans, you can still walk out of there with up to $20,000. So it's worth, if you qualify, it is definitely worth opening up one of these plans for sure. Also, the RDSP is exempt from most provincial disability and income assistance benefits. So I was assuming everybody here was going to be from Ontario, so I'm very Ontario focused, but I know there's somebody on the line from BC. I can't speak exactly of how it works in BC. I'm guessing it's similar, but you'd have to check for yourself. Or I can check for you, but the money that you receive from your registered disability savings plan down the road when you're withdrawing it, it does not get clawed back. So that's important. And it does not reduce your disability benefit payments. So like ODSP, right? So this is actually works very well with those programs. People with disabilities can choose what they do with the money when it comes out. There's no rules around it. It's your money to live off and however you choose to. And there is a lifetime contribution limit of $200,000 with no annual limit, meaning you can contribute as all of it one shot. Not the smartest thing to do because the government will restrict how they do their matching. So typically the normal situation is somebody puts in $1,500 a year. We're going to get into examples later, but you could put in $1,500 a year, but you can do more if you're catching up for previous years. So for example, if you would have qualified 5 years ago, there's nothing saying that you can't put in the money from 5 years ago and do that all in one shot. But you have to be careful because there's a limit to how many bonds and grants they'll give you in 1 year. So you might have to spread it out over a year or two. Okay, so RDSPs, who can benefit and where to begin? So that's the question. So RDSP can be set up for a beneficiary who is eligible for the federal disability tax credit. That is the requirement. You need to be receiving the DTC, okay? That is what you need. You also need to be a resident of Canada. You need to have a valid social insurance number, and you have to be under the age of 60. And I would say personally, you should be under the age of 50 to set one up because there's some rules about how long the money has to sit there before you can pull it out. So if you're already over 50, this is probably not going to be a good plan for you. It probably won't work into the same way that it would for somebody under 50. All right. So where to begin? The person who opens the plan and makes decisions is called the holder. Okay, so that could be the disabled individual if they are adult. It could be a parent if the individual is a minor. It could also be a family member if the person with a disability does not have capacity to make those sort of decisions. That person, the holder, will determine the contribution amounts and select the investments and manage all the withdrawals. So it can be a parent, a legal guardian, or the disabled individual. And that person could also authorize contributions from other family members and friends. Okay, next slide. The disability tax credit is a non-refundable tax credit. It's a federal tax credit used to reduce the amount of income tax that you pay. It is available for people with a severe and prolonged physical or mental impairment, and that needs to be approved or subject to approval by the CRA. It is also meant to help even out the tax burden by allowing some relief for disability costs, since these are unavoidable additional expenses that other taxpayers do not have to face. So they're trying to, help in that sort of way. For 2018, you know what, I should have I've updated this. This is actually 2021. The numbers are correct for 2021. I forgot to update that year. But for 2021, the federal non-refundable disability tax credit is 18,000. Hang on one second. Maybe it was a different slide that I updated. Okay, let's pretend this is correct for 2018. It was 8,576. If the person with the disability is under 18, there is an additional supplement amount of just over 5,000 for a total disability tax credit of 13,579. Okay. You know what, that's updated. I'm pretty sure it's for 2021. So this amount is multiplied by the lowest federal and provincial tax rates to determine what it actually is the dollar benefit. Because what I've showed you is just the disability tax credit. That doesn't mean anything. I wonder how much money am I going to get in my pocket? That's what you need to know, right? So based on the lowest tax rates and based on what the disability tax credit is worth, that's worth about as much, around $2,700 a year, how much you can be getting back for just having the disability tax credit. So for sure, if somebody thinks they could qualify, it absolutely is a great thing to try to get approved for. And if there's a child or another dependent that doesn't have any taxable income, then a parent or any other relative can claim it under certain conditions if they're a caregiver or what have you. But that's more of a question for an accountant, so to speak. So the main point is disability tax credit is what's required, and there's some significant financial reasons why you'd want to do it outside of even having the RDSP. How to qualify? This is going to be an important question. So to qualify for the disability tax credit, you have, now this was written about 2 or 3 years ago. I don't think anything's changed, but at that time you have to submit a form T2201. It's the disability tax credit certificate form, and the CRA must approve your application before you file your income tax return for the year you are claiming the credit. The disabled person or a family member, they would complete one part of the form, and then the medical or health professional would complete the other part of the form, depending on what your disability is, right? So a medical doctor is typically what it is. Could be a psychologist, could be an audiologist if it's to do with hearing, optometrist if it's to do with vision, or an ophthalmologist, depends, it depends. And based on the circumstances of each case, the CRA may approve it for indefinitely, because they say, yes, this person has this condition, it's not likely going to change, or they may approve it for a shorter amount of time. So say 5 years or 10 years, because the nature of your condition is that they'd have to reassess to see where you are at that point. So I just put a little sort of comment that somebody who writes a personal financial blog, who applied for the DTC on behalf of his son, and that individual, Reese, had high functioning autism, so was very functioning, but was on the spectrum. So when he got approved for the disability tax credit, it was for 10 years, because they want to re-diagnose and see, hey, they're not looking to give it, they want to make sure it goes to people that qualify, right? Which is fair, I think. But if you qualify, you're going to keep getting it. And let's say you would have qualified 8, 9 years ago. That doesn't mean, oh my God, I missed, I'm out of luck. There's another form that you can fill out, the T1 adjustment request. And you're going to be able to go back as far as 10 years, right? Which is great. So if you were, let's say pretend somebody was born with a certain condition, but you just heard about this today, right? So we can't help you from the day you were born, but these plans have only been around since 2008, right? So to be able to go back 10 years, we're almost going back to the genesis of when these things were created, right? So one little thing I just say, stay away from people that will try to fill out the forms for you. There's a lot of scam companies out there, and they target people to saying, hey, this is complicated, we'll do it. They won't do it for free. They're going to take some of the money that you get from the government through your tax return. So just be aware of that. Okay, so government funds. Let's go really quick here then. Okay, the amount of money you can contribute is, it's always, $1,500 for the most part, for what I think most people will see, $1,500 a year. But how much you get in matching is going to depend on how much income you earn. So if you are doing this for a minor, it's going to be based on your parents' income, right? And if the parents make more combined than $98,000 roughly in this year, then you will get the matching rate. You can only contribute $1,000. But if your family income is less than 98,000, if $40, you can contribute $1,500. They'll give you an additional $3,500, right? And this is just on the grant. So basically, if you have less than 98,000 bucks, you're going to be getting the full amount. So we'll skip to the next slide. This is just an example. It's an example of somebody that did contributions for 4 years. They didn't earn more than 90,000. They put in 5,500 and they got back 12,500. So it's just to show it can be a lot of money. There's also a bond. That's for people that are lower income. If they earn themselves as an adult less than about 32,000, or as a family less than, if you have a minor child less than 32,000, you will get $1,000 from the government. There's a sliding scale between 32 and 49 that will do a prorated amount. So the main point is less than $49,000, you're going to be entitled to a bond. We'll get into details later if we want. Let's go. Well, here is an example, basically, just to show you, of somebody who contributed $1,500 a year for 20 years at 6%. That's what they earned. They only spent $30,000 in total, but at the end of 20 years, it was worth $234,000 almost, right? This is really just to show you that this thing can really, really grow if you keep up at it, right? And if you try to earn that kind of money outside of an RDSP, you'd have to be earning 18% a year. So basically the main point is start if you can really quickly, okay? Now, withdrawing. You can withdraw money, but there's a 10-year rule, right? So basically that means that you can't withdraw money until at least 10 years have passed from when the government gave you matching amounts. So if you put in money 9 years ago and you pull out $1,000, they are going to take back $3,000. So you really want to have a window of 10 years between the last day the government gave you money and the time that you take the money out, which is why I say really the only thing to think about is 49 gives you that 10-year window before you have to take the money out, at 60 basically. So that's the main point of this slide. You don't want to penalize yourself. You want to grab as much of that money you can for yourself and not give it back to the government. So again, just showing examples of different contribution amounts at different income levels, putting in the same amount, $30,000. The scenario 1 is somebody at the lowest income level, and scenario 4 is somebody at a higher income level. The main point is showing that they're putting in the same amount of money in each case, $30,000 in total over 20 years in this example, but the growth is actually grown more for that person at the lower income level because there's just more money there. There's more matching, there's more bonds. It's just more support for somebody at a low income level. I won't get into, this is too technical. It's getting into how much can you take out at age 60, all that sort of stuff. It's in the brochure that I'm going to send out. Let's not waste time on that here. Okay, here's really, I think, the last slide, to be honest. This was current as of 2018. I don't know if there's been an update. People will always be concerned about, well, if I have stuff, is that going to impact payments from the Ontario government? They made some changes in 2018 where they said, hey, you can have assets of up to $40,000 and we're not going to hold that against you. And if you're a couple, if you're married, then 50,000. And there are certain assets you're allowed to have where it won't have any impact to your disability payments. A residence that you live in. So if you live in an apartment, a condo, or a home, if you live in it, that has no impact. If you have a car, it has no impact. Funds held in an RDSP, which is why I have this bolded, no impact whatsoever. Assets held in trust, we're going to get too many complications there. But the main point here is that an RDSP is one of those assets that you can hold and have full confidence that it will not impact any money that you're receiving from the Ontario government. RDSP is federal, federal, but it won't impact or kind of mess you up anything on the provincial side. I don't know what happens in BC because I'm not licensed to work there, but I would assume it's probably very similar in that way. So I think that is probably my last slide, to be honest. So maybe we can open it up to some questions. I know I went fast. I know there's a lot of info. The brochure I will email out to DEEN Support Services will really get into the numbers and the nitty gritty, but happy to take, or I'll let you ask the questions on their behalf.
Okay, before we go into the questions, I just want to ask, what is the criteria for someone qualifying for the RDSP? What's the criteria?
Yeah, so it was on the previous slide. So it was disability tax credit. You need to qualify for that. You need to be a resident of Canada. You need to have a social insurance number. Those are the three requirements, right?
What about,
and let me just say one more thing. If somebody qualifies currently for ODSP, okay, I would say that is a stricter qualification than getting the disability tax credit. So you would likely qualify for the disability tax credit.
Is there an age requirement?
Sure, you have to be alive, right? So if you had a child that was born, I think it's like 2 weeks. If you had a child that was born with an obvious condition, let's say Down syndrome, right? Then you can open up an RDSP for that child that year, okay? Keep in mind though, because the matching portion of what the government will give you is based on family income. If that child has parents that are, let's just say make above average income, okay? That the contributions that child will receive will always be on the lower end. But let's just say that child hits 19 and is still being supported by the family and having the same lifestyle and all that stuff. They don't care that the parents make $1 million a year. I'm just making this up as an example, right? They're gonna totally base it on that child's income, which might be low or zero or whatever the case. So, so for somebody who has a kid that's 15, 16, 17, you may want to look at, okay, is it better? And I only have so much money to contribute. Does it make more sense to wait till the child is 19 to do it? Or does it make sense to do it now and get as much as I can get now? Because there's a limit, right? So how much you can get. I will also say is that you need to file a tax return for said individual. And if you have a 19-year-old, like when the kid's 19, for an adult, so 19, but they base it on your tax return from 2017. So you should be filing a tax return for the child for 2017. Even if they have no income, just file it, right? It's not, you don't 100% have to, they'll assume some things, but it takes no time to file that tax return, especially if it's very uncomplicated, right?
Okay, and what's the maximum age to be qualified for the RDSP?
59, because you have to take the money out at 60. But again, if you're starting this off from scratch, meaning that you've never had one before, I wouldn't look at this if you're over 49, because you will miss out on the 10-year window. So remember, there's the window where the government will give you them, if they give you money in when you're 49, then you need to wait 10 years. So starting at age 50, 51, up to 60. If you have got contributions during those years, they're going to take back $3 for every $1 you take out, right? So really 49, I would say, and in that year you can go back and make contributions for previous years, up to 10 years or what have you. Even then you're pushing it, right? You're kind of pushing it. So ideally you want to do it as early as possible, you know, whether they're a minor or adults, you don't want to do it too late in the game. And also because you can't make all the contributions there's a maximum how much it'll give you in 1 year as far as matching them out. So, you know, you have to look at every scenario specifically.
All right, let's go to the questions. We have about 5 questions. All right, the first question is from Faiza, and she says, I have a carryover amount of 4,500 for this year, and I was wondering, when does the year start and ends? Is it for February?
January to December. It's a full year, right? It's the calendar year, right? But just be aware of what your past contributions were, right? So you want to just, I think you're going to be totally fine, not an issue, but you want to make sure that whatever you're contributing will get you the maximum contribution amount. So I know of one person who set one up for his son, who was an adult, but had severe autism, and he set up one and he made a big contribution 1 year, and he was told by somebody on the government's department that yeah, he could do it. But what happened was maybe he didn't understand. I wasn't there, I don't know, I'm just going by what he told me after. He made too much of a contribution and they only matched up to a certain amount. It was fine, like he made a contribution, he had the money, but he could have probably put in $5,000 less and still got the same amount from the government. It is what it is. You just need to be careful, right? I don't think it's going to be an issue in Faiza's case, but you can go back and you can go back for those years and put it all in.
Thank you. Okay, she also said that also I didn't contribute anything last year, and will it get carried over to the next, or did I miss my mark?
No, you can always go back up to 10 years, right? And that's totally fine. But if a person is let me just think here. Yeah, you can go back. Just keep track of it. The easiest thing is to phone. There's a specific phone number with the federal government. That is the RDSP office. And those people are actually usually pretty good to tell you exactly how much I can contribute this year. I tried to phone them sometimes for clients, but they won't, unless they've authorized me to do it, they're not going to give me, and I don't blame them. It's a privacy issue, right? But they're there to support you, and they're pretty good, right? I would always check with them before you make a contribution. Say, hey, how much can I put in? You know, can I do this year? Like, they'll do it for you, not a problem, or tell you.
Okay, the next question from Asia, and she says, can you please explain how we can decide whether to choose stocks or bonds for the RDSP contributions?
Okay.
Pros and cons for each, and are there other options?
Sure.
Which is most secure, yet also avoiding interest?
Okay, so that was a lot of stuff in that question, which it was a great question, by the way. And just so you know, putting a contribution in there and just even putting it in cash will get you those huge matching amounts, right? What to invest in. So it's not an easy answer, because the first thing I would tell any client in any investment in any type of account, regardless of RDSP or TFSA or whatever, is that you need to fill out, or I do with the clients, a risk tolerance questionnaire. And that basically, it's very simple. It takes 5 minutes or 10 minutes to fill out. And it will basically tell you at the end of it what your risk tolerance is. Most people have moderate risks, right? Some people are very conservative, older people, like when they're closer to retirement, and some younger people. I have a cousin that can't sleep at night if he loses a penny in an investment, right? Because that's the way his mind works. That's okay. It's the way Allah made him, right? That's him. But there's other people that are very aggressive. So you can, so what you invest in depends on your risk tolerance. And when any financial institution should be asking you that, because they shouldn't be putting you in anything that's outside of your preferences in that way, compliance related. What can you invest in? You can leave it in cash. You can put it in mutual funds. You can put it in stocks. What is best depends on your risk tolerance. Now, if we're talking about respect to, some people have issues with the type of investments they put in that garner interest. Some people don't. Some people, everybody is different. That's okay. I'm not here to judge. It is what it is. There are ethical traded mutual funds that are, I wouldn't say they're Sharia compliant, but they're very similar to at least some of the aspects to how Sharia compliance works, not on the interest side. But you can also work with an advisor that can help arrange a portfolio for you. I can tell you that we just at my company, I work with IG Wealth Management. We've just started using a Sharia compliant ETF. So it's basically like exchange traded fund that is a balanced global fund that is 100% Sharia compliant. The people running, the advisors on there are from a variety of different Islamic type of think tanks and what have you. The portfolio manager isn't Muslim, but he is guided by the principles set by the board of directors and whatnot. It's brand new for us. I haven't looked at it in detail. It is but it would, that for sure with our company would meet the need. But there are other companies, there are other ways you can do it. It's something that you'd have to talk to somebody one-on-one to get on that, and that person can judge, okay, what is it that you're really trying to stay away from, and devise something there. I would say the lower the amount of money in an account, you don't want, you need to make it as simple as possible. You don't want to start buying little different stocks. You just get something that's balanced, maybe an exchange traded fund, a mutual fund, and as long as it meets the your ethical requirements, that should be the best way. It'll be diversified in the best way possible.
Okay, thank you so much.
Sure.
The next question from Asia again. It says, can the RDSP backdate to when the disability tax credit start date is backdated? And if there was an error in the DTC start date, which is being backdated, is it better for the DTC start date to be updated first, then open an RDSP, or still open?
I think it depends on how long it takes them to fix that error, right? If you know that the error is, hey, he or she should have been eligible 8 years ago, but we have him down for 5 years ago, there's nothing going to stop you from making contributions for the last 5 years. That's not going to impact anything once they fix it up, right? Mm-hmm. That's something you probably want to talk to the RDSP office about specifically. It's their process. They understand how that sort of works. What was the first part of that question? I'm sorry.
Can the RDSP backdate to when the DTC start date is backdated?
So the RDSPs only were created in 2008. So there was no RDSPs before then. We're now in 2021. You can only go back, my understanding, unless something's changed, 10 years. So you can go back that far. Typically, that's about as far back as you're going to be able to go, which is still great, right? Like it's 10 years of matching you're going to be able to get from the government, right?
And so can you open an RDSP before? What does one do to ensure it backdates to receive government contributions from the correct start? So
there, like you can imagine with any government plan or program, there's lots of paperwork, right? And lots, it's a bit confusing. The main thing is try to have your paperwork from the government in order and take it to your bank or your advisor, because that's the person that's going to be doing everything for you. I will tell you straight up that the majority of advisors don't know how these things work. And it's to their defense, it's because they don't see a lot of these. And the reason I probably know more than and I don't know everything, I'll be straight up, I'm going to tell you. But the reason I know more than the average person is because I had 1 or 2 clients that had children that had disabilities. So I had to understand these things. And I could tell you that the one person, he had told me, he was an uncle, not a real uncle, but an uncle in the Islamic sense, an uncle of mine who had an adult child who's in his maybe 40 now, but a few years ago, he said, I went to my bank, I think it was TD, and they, the teller or the advisors, 25 years old and just learning the ropes, they don't know anything about RDSPs. That person sent him a link to the government document, and he told me that the document was 500 pages. Now, I went to the document, it wasn't 500 pages, it was 50 pages, but it felt like 500 pages, okay? And I totally agree with him on that sense. And you can't send somebody away to go read this and understand it, right? But the more you can figure out ahead of time. And I'm happy to, chat with any of the people here. It doesn't mean I'm going to become your advisor. It doesn't mean you need to, don't worry about that. Okay. We're all Muslims. We're all trying to help each other out to a point. And I'm happy to give you as much info I can give you and steer you on your way. And if it means that you should go to your local bank, great. I just want this to be set up for as many Muslim, non-Muslim, regardless, anybody that has a disability, if there's, why wouldn't you want to help people, right? So that's what I would do.
Okay, so thank you.
But just be aware, you walk into a branch, they're not going to know a lot about this stuff. So if you're armed ahead of time, it'll make everybody's life a lot easier.
Okay, thank you. We really appreciate that. Okay, next question from Asya again, and she says, what's the minimum and maximum recommended contribution when matching government contributions? Okay,
so recommended is really down to your personal situation, right? So not everybody has a lot of, my recommendation is to make sure that you have food on the table and make the basic needs for life. After that point, if you still have money around, then we start looking at, okay, how much disposable funds do I have to put into it? If we're still okay on that point, then the recommended amount would be to max out the bonds and grants as much as possible. Usually that's going to be for people that are at income less than 49,000, a $1,500 contribution for each year. Okay, so $1,500 times the number of years that you're eligible. If you're going back 5 years, then do 5 times 15 or $7,500. You can put in a lot more, but just know that you're only going to get matching on a certain portion. So does it make sense to put more in it? It depends. Like if for whatever reason, if there are parents that have a significant amount of financial ability to do so, then there is a reason to put that money in now, because it will grow in a way that's going to be tax deferred. It will, but then you're looking at different things. It becomes a bigger discussion rather than, put in more. Like you have to look at the big picture of other things. But at least try to maximize the grants and bonds. Usually $1,500 a year, at least $1,000 a year.
Okay, great. Thank you so much. And Lizette have a similar question, and it says, what would you say is an ideal contribution yearly for someone only making about 18,000 to 25,000 yearly?
Sure. So for that person, if they can afford the $1,500 a year, that will maximize what the government will give you. And just in that specific situation of that range, I can tell you that you putting in $1,500 a year, you will wind up with $6,000, because there's going to be grants, and it's technical. You get 300% of the first $500 you put in, you get 200% of the next $1,000 you put in, and then you get a $1,000 bond if your income is at the range that the sister asked, right? So for that $1,500 contribution for her, it will be $6,000. So that is the amount that, if you can afford it, that is the amount I would put in for sure, every day, every year, for as long as I can. Okay, great. Thank you so much. It says here we want a Muslim advisor. I am a Muslim. I mean, I guess depends who you ask. But I'm fun. All right. Well, I'm trying to make this fun. I know the topic's not exciting, but I'm. You know what? All kidding aside, it's an important topic, and I'm happy to give anybody just advice, right? And you do with it what you want to do. Yeah. There's one more question I missed. It was in the chat. What will be the total value in age 60 if someone contributes $1,500 for 50 years? So you can't contribute for how many years? Sorry? 50. Well, you can't contribute for 50 years because there's a maximum amount of years. So what happens? Here, let me give you an example. If you had the child that had Down syndrome and you start contributing, because it's a known disability, right? It's not something that occurs later on. It's okay, the child was born with Down syndrome, they're going to qualify for the disability tax credit. So if you opened up that account at 2 months later and contribute, you could, in essence, be done contributing by the time the child's 20 something or 30 something, And then 10 years after that is when you can start pulling out the money. So 60 is the latest you can take it out, but you can actually start taking it out earlier depending on when you started. How much would anything be worth? There's some examples in the slide deck with some assumptions. It really depends on how much income did you earn during those years? What was the rate of return on your investments? What was really, that's the grants, the bonds, the matching, how much you put in, how many years you put it in, what was the growth? There are calculators that calculate that, but you'd have to plug in all the numbers for all those years. I will say it will be significant. You will never get this type of free money from the government ever anyway. And who knows, I don't imagine the government would get rid of this program. It would be very, very bad optics for them to do that. I think it's a program that has not been well marketed until recently. They've started doing a little bit. The number of individuals I see that I run into that deal with people with disabilities as their job, they work with, behavior consultants or whatever the case is. I often ask them, have you ever heard of an RDSP? And they look at me and they scratch their heads and they go, I don't know, I'm not sure. And honestly, I tell them, you need to know what it is. You don't need to know how it works. That's not your job, but you need to know what it is so you can tell your clients and your people that you support it exists, and for them to go find out about it. Because if they don't tell them, if DEEN Support Services doesn't tell them, and good for that because you're telling them today, but if you don't tell them about it, how are they going to know about it? It's not going to be from me, because you're the person dealing with those people, with people with disabilities. So that's great. DEEN Support Services is making a point of trying to make people aware of this. That's awesome, right? Not enough people know.
That's so true. That's so true. And the benefits for this program, how much you get back is like so much more.
Oh, it's crazy.
Yeah.
In a good way, crazy.
Yeah. Yeah, we have another question here. If I'm not sure if I heard this, can you recommend us any Islamic institution that we can open our RDSP account?
Okay. Yeah. Well, no. So I'm going to be honest, right? Because you have to open it up in Canada. You're looking for an Islamic institution. I got to tell you, this is going to sound bad, but I can tell you of one. I'm not going to name the name of a company, but I remember a friend of mine that set up an Islamic mortgage company many years ago, the most honest, ethical person you're ever going to find. And we were chatting once, and he told me about an Islamic mortgage company that was doing something, and that guy ran away with the money, right? So you want to deal with an institution, okay? Like a bank or a financial advisor that is backed up by, that can, in case something happens. You need to then deal with the advisor that can put your assets into investments that meet your ethical needs, right? So it's not about the institution, it's about what are you investing in. And a lot of depending on where you go, they have access to different types of products. You can, like I said, our company just came up with a brand new one. That's one, but you can do, and by the way, you don't have to work with an advisor. You can open this up self-directed online with your bank, put your own investments, pick your own. It's, you reduce the amount of fees that you pay. And if you are so inclined, there's nothing wrong with that. Right? But for usually people like to, quite often people like to work with somebody that can help them, assist them in that way.
So if someone goes to the regular bank, they can ask for Sharia compliant.
You know what? It doesn't mean they have a product, right? It doesn't mean that everybody has something. They can maybe, and here's the other thing is, unless we're talking about, how do I say this diplomatically? Most advisors, okay, will be working with clients that have a minimum of a certain amount of money, okay? So there's another reason, if somebody shows up with an RDSP that has $4,000 in it, odds are they're going to direct you to the bank, because it's not, this sounds really bad, but the time and effort required is not going to be worth it for them, right? And that's just the reality. Now, that doesn't mean, now a family could have an RDSP, an RESP, the parents could, when you combine it all, and if it adds up to a certain amount, then that advisor may, take you on. Again, I'm happy to chat with anybody just to give them some information. But even in any of the larger institutions, there will be Muslims that are working there, and there are some that are targeting, you know, Muslim investing and Islamic principles. Again, it depends on how strict you're adhering to these things. They don't need to be Sharia compliant products, but if they're structured in a way, you can use regular products that do the same thing, right? It all depends. And again, it's a conversation you should have with an advisor to see what makes sense. You know, sometimes, to be honest, some people they have matching plans at work and they put contributions there and they have no control over what happens. So sometimes for the people that are very observant, they'll say, okay, whatever I made in interest, I'm gonna just park it. I'm not taking it. I can't control some of these things, but I can not profit off it or whatever the case. It's a discussion to have one-on-one with somebody.
Okay, thank you. The last one here says, the last question we have is, God forbid, if the beneficiary is not alive, what will happen to the contribution?
So if the beneficiary passes away, it will just form part of their estate, okay? And then the other side question to that is, what happens if I opened up an RDSP, they gave me a disability tax credit for 10 years, they revisited 10 years later and said, you don't qualify anymore. So you have to kind of stop with that RDSP. No, you don't have to pay it back. You don't have to pay it back. I'd have to double check what the rules are, but you kind of have to stop it at that point. You're no longer eligible. And there's some processes that you need to deal with at that point, so to speak. So again, one of the things to think about is my disability long-term in nature, or is it something that might not be there 3 years from now? Is it worth going through this if, you know, it's a physical thing that I injured myself, but I'm going to rehabilitate and get better, right? I mean, that's a little different than somebody. The other thing I wanted to say was, it was on one of the slides, we glanced over it. Most people will apply for a disability tax credit, they're going to get denied. Don't stop. Send more information in, especially this happens more on the psychological side versus the physical side, because if somebody's visually impaired, it's very obvious what the disability is. If somebody is deaf or hearing impaired rather, or has something else, that's very clear. But if somebody has a combination of other factors that when you combine it would classify you as disabled, right? That becomes a little bit more of a gray area. And especially the psychologists are able to go back and forth, back and forth, back and forth. And it might take a long time to get approved, but don't stop. Some doctors, I will say, medical doctors, they hate filling out the forms, right? They'll just look at you and go, oh, you wouldn't qualify, or why are you gonna bother? Don't take that for granted, right? Because if it is a, you know, a mental thing or something else, the psychologist might have a better aspect of being able to help you, right? It's paperwork. Nobody likes paperwork, right? But if they're really supporting you, then they should be able to assist in that way, to be honest, right? And again, if you get the ODSP, you likely will qualify for DTC. Okay.
Thank you so much. Wow, the time went so fast. It's already 8:01. I just want to confirm this last bit of information. So if someone is 50 years old, there's no benefit in them investing in this.
I would say if you do not have a plan already set up and you are 50 years old,
yeah,
I wouldn't bother, because what happens is the matching stops at 49. So you're not going to get any more dollars from the government at that point. And you can't even go backwards to pick up the years from before, because that 10-year window will basically screw you, right? So you need to be no older than 49 at the end of this year, okay? So as long as you were 49 at the end of this year, you can open one up this year and go back a few years, right? But even then, you'd have to sit there and think, is it worth it? Because unless I'm going to go back a few years and make up for those past contributions, this is the only year I'm going to be able to contribute. So is it worth going through the headache for a $1,500 contribution? So the key is start when you're younger. If you're an adult, it doesn't matter. Like as soon as you're 19, it doesn't matter what your parents make. whether your parents could be doctors making a lot of money or lawyers or whatever, it has no impact on how they'll look at you, right? So do it, get it. I think it makes the most sense, do it then, but do it earlier for those kids that are minors too. And again, it depends on the total situation of your family, what's going on. I mean, RDSP is one thing. There's other things, not for this conversation, but setting up a Henson trust. If you want money, like when you pass away as a parent, if you have a child that is not able to make those decisions, setting up a Henson trust, having the money in there, that is a way to have money for that adult child for their support without impacting their disability payments outside of an RDSP. It can get a lot more complicated. It depends. It depends on a whole bunch of situations, right? Today, we're just talking about RDSPs, but financial planning is not about one thing. It's about everything, right?
Okay, we have 2 more questions coming
up.
Okay. It says, I'm eligible for the disability tax credit, but I'm wondering, when I wanted to open RDSP, some company told me to bring medical form. Do I need it while CRA already have one?
Okay, so how old is the person?
I don't know. Can you send back the information to us so we know how old the person is? Okay, in the meantime, we'll go on to the next question.
No, that's fine. It doesn't matter. The person's an adult, so we'll leave it at that. You've got the disability tax credit. That is fine. Well, I don't know what medical, there's our forms you need to fill out that are the RDSP forms. And there are, all you need to fill out are the forms that come with that. There's a few forms. There's like, 3 or 4 different government forms, but I don't, and part of it will refer to your medical. It won't even talk about your condition. It's going to say, are you DTC eligible, right? Do you have it? Not eligible. Do you have the disability tax credit or qualify for it? Because they're going to do a cross-reference when it comes time to giving you the matching and the matching amounts. So, I don't think there's a medical form. If you've already filled it out and it's been approved, there's nothing, if this is one of those, you know what it is? Sorry. If this is one of those firms that is trying to help you apply for something, they're looking for those medical forms. And I'm not saying this is a scenario, but be very careful about a company that's trying to help you fill out the DTC application, because what they're likely trying to do for no fee is to help you and then take a chunk out of the disability tax credit money that you get, right? No large institution will do that. So you're very safe to go to your bank or a company that you've heard of. But if it is Imran Choudhary Inc. and like disability for me, then I'm very cautious about like those sort of individuals, right? Just be careful. I don't want to throw anybody under the bus, like as far as that everybody's unethical, but you know what? I don't want you to take the chance that you run into the person that is.
True. Thank you. All right, the next question, and I think that would be the last question we have, because we need to wrap up, and it's, what is the maximum years to contribute for my 6-year-old to get the maximum benefit? And she's saying here, what I understand, I can't contribute for 50 years.
Well, it's not so much the years, it's the amount that you're allowed to receive in matching, right? So they'll give you $70,000 in grants maximum, okay? They will give you $20,000 in bonds maximum. They will allow you to put up as much as $20,000 in contribution maximum. How many years depends on the amount that you contribute, the income level that you're at, right? So if you're a higher level of income, you're going to get less matching for the government. So in that, if you're an adult and you're in that scenario, or if it's for a child, I think the sister was saying, if it's for a child, they're basing it on the parent's income. So you're looking at it and going, okay, well, we make this much. Okay, then what's the likelihood of what our child's going to make at age 19? Then you factor that in. And so the number of years depends really on what it takes to maximize the contribution, the matching the bonds and the grants. So it's not a number of years. It's once you hit the maximum of the bonds and the grants, or you over contribute to 200,000, you're done at that point.
And just to clarify, the bonds are for people within a specific level. Is that, I mean,
Yeah.
Haniff?
So basically, so they change the levels every year. It's on their website. But for this, and when you go back 4 years and 5 years, they base it on whatever it was that year. But I can tell you for this year, the high end of the lower income is $32,028. Okay. When the program started, it was 21,000 and change. Right. So it's slowly increased by one. Well, it goes up and matches inflation. Right. So last year went up 1%, the year before 1.9. So if you earn less than 30, let's call it less than 32,000, be assured that you are going to get the maximum amount for that year, right? And if you are consistently making less than, I can tell you right now, if you are consistently making less than $25,000, then you're going to get the maximum amount for the last 10 years. Okay, that's a good rule of thumb.
Okay, there are more questions coming in.
That's fine. You know what? I got nothing better to do.
Okay, thank you. I appreciate that. All right, the person was saying that the person is 31 years old and have a permanent disability. Okay.
What's
all right.
The question? Sorry.
That was the
question.
That was the question where you answered already, but it was just the next question is there any way to prove you are DTC recipient? We don't have any sort of paper to prove it, but we called to CRA and they said my husband is a recipient when they looked at his file.
Yeah, so I'm not sure if they give you a number. I think it's just in their, I believe it's just in their records. So when you fill out the paperwork, they're just going to literally say, are you a holder of the disability tax credit? And you tick yes. So if you tick yes and you're not, I mean, eventually it goes back to their office. They're going to do a cross-reference. And then they're going to say, sorry, you don't qualify, right? So nobody's going to go through the headache of filling out the paperwork if they don't qualify, right? So I think, that's why they have your SIN number on there, because it's all tied back to that, so to speak.
Okay, great, thank you. Okay, and the next question is, does the $1,500 contribution, a year contribution, have to be all at once at the same time, or can it be done in smaller amounts throughout the year?
It's absolutely fine to, like I think for most people, not a bad investment decision is to set up, you know what, hang on a second. You can set up a pack where you just are like a contribution every month, right? It's called dollar cost averaging, and you just put in $100, or in this case, a little over $100 a month, 125, I guess, and then you put that in every month into this thing. That should be fine, because you would have an RDSP set up with an institution. The funds are going into the institution. Yeah, that shouldn't be a problem. Shouldn't be a problem, because they'll give you a record at the end of the year, or they'll have a record of how much you've contributed. It doesn't have to be in one shot.
Well, you have to set up that.
You have to have it set up. Yeah, you have to have it set up.
And what is it called? Dollar what?
Oh no, so dollar cost averaging. So setting up is just a pack. It's just the same way you pay. Let's say every month I put $50 into an RRSP from my bank. They just do it,
okay,
right?
So the bank can,
yeah, they can set that up.
They can set it up.
Or your institution. But what dollar cost averaging, the concept is, that's not a bad thing to do, because sometimes if you put all your money on one day in the year, we don't know if that's the year when the markets will drop a lot the next day, right? Because COVID happens and things happen, and things happen like that. But if you put in you don't think about it, you just do it every month, you put in money, then you're going to take some of the guesswork out, because you're going to get it sometimes when the market's up and down and up and down, and it makes life a lot less stressful and a little bit easier too.
Okay. All right, I think that's it for now. It's time for Salah too. So inshallah we get it.
There we go. We timed it up really well.
Yeah, alhamdulillah. Thank you so much, Imran, for your wealth of experience, your wealth of knowledge. We've really, really learned so much from this session. And I want to really thank you for all those who attended too, and all the amazing questions that you asked. And as I said to all the participants, inshallah, we will follow up and send you more information, the slides and the brochure that you're going to give us, inshallah. All right.
Okay.
So thank you all very much. And inshallah, next time, take care. Assalamu alaikum wa rahmatullahi wa barakatuh.
Okay, welcome, Sam.